Hey guys, welcome to FX Chronicles. This is Azam and it is December 16th, 9:40 p.m. Central Standard Time here in USA, Houston, Texas, H-Town reppin'. Alright guys, I hope it's been a while since I've actually done a video. I haven't had time. I've been really occupied with some personal stuff and I'm just getting back to it. So the one thing that I did want to discuss in today's video, before I get started, is the disclosure obviously that this is all just purely educational information that you can find online as well. My advice, you should not take any legal directions or don't take my financial advice seriously at all, and just contact a financial advisor if you have to. And there's risks associated with Forex since it's a derivative with high risk, as I said earlier. Okay, that being said, getting back to the point, so in today's video I actually want to discuss with you guys a few things, questions that a lot of people have been emailing me about or privately messaging me about on Instagram, or just newbies who are starting off with Forex, and these are questions that are very legit, is to understand, how the trades are put in, how am I managing the risk, or how do I make sense of, how does one make sense of my Instagram pictures that I post where I say like I made a 50% gains or 50% return on investment, 200% return on investment. What does that mean? And how is that all calculated? So I'm going to do a crude measure of that in this video. Hopefully this is not going to be too long. I have most of the stuff already prepared for you guys, and do check this video a lot of times. And if you are going to be dabbling with Forex, contact me by all means. I would love to help you guys out. And start off with a demo account. You don't want to be throwing your money at just risking at it right away. Everyone's really hungry. Everyone wants to make money. That's why we're in this business at the end of the day. It doesn't matter how many strategies you have. What matters is if you make money. And everyone wants to get started right off the bat, like tomorrow. But you need to understand the tools that you're using. Learning Forex isn't that difficult. It's really understanding the platforms that you're using and what that technology means to you, and how can it facilitate you in bettering your trades. So okay, let's get started here. I think the first thing I want to do is go over this part. So with Forex, there are three different kinds of I guess the unit that we trade Forex in. For instance, in stocks you're trading shares. In Forex you trade lots. Lots are, for instance, 100,000 units, or volume of one lot equals to 100,000 units. Just remember that, and I will come back to that briefly. So we have a standard lot, which is 100,000 units. We have a mini lot, which is 10,000 units, and then a micro lot, which is 1,000 units. So standard is 100,000 units, mini is 10,000 units, and micro is 1,000 units. What does that mean? So for instance, let's take a quick look here in trading. Okay. So let's take a quick look here at this pair. This is the euro dollar, and what we're seeing here is the euro dollar. We're seeing whatever, we're just seeing the chart here. So if you had to take a trade, let's just say you had to take a trade. I've done this video before about FXCM platform. That's the one that I use, and I talk about how the volume is analyzed and everything. So you see my account number, which you should not be seeing in the first place, but okay. Euro dollar right here. We have buy or sell, and we have the amount K. The amount K is representing the units. So what did we learn? We know that 100,000 units equals to one standard lot. So we already have a K here. The K represents 1,000. So you make this 100. So that's 100,000. Okay, that's a standard lot. 10,000, which is 10K, is a mini lot. And the smallest you can go is micro lot, which is 1K, which is the generic that you're provided with. Okay. And that's the first step in knowing is how the volume is put forth. Instead of shares, we use lots. So the smallest is a mini lot, which is 1K. Now comes the second aspect of this. How does that reflect my trading? What does that mean? So here's a little example that I've created. Let's just say you have a $1,000 Forex account, and I swear this question has been asked to me so many times that literally people are starting off with $1,000 or $2,000, and they're like, how much can I risk or how much can I make on a trade and all that. So let's just say you have a $2,000 Forex account. What does that mean? How much can you trade? So because of margin on a Euro USD paid, you can only trade up to mini lots, volumes of 10,000. What does that mean? If you have a $2,000 account, what do we know a standard lot is? A standard lot is 100K, 100,000, okay? If you want to take a trade in which you will be trading 100,000 units of something, you need to have a minimum, this USD, it's margin, USD MR is margin, or the amount that your account needs to have stored in it to be able to take a trade like this has to be $2,800. So if you have a $1,000 account, you cannot trade a standard lot because the margin requirement by the broker itself is $2,800. So you perhaps want to have a $3,000, $4,000, even $5,000 account to trade a standard lot. That's the first thing. So since you can trade a standard lot, you can definitely trade a mini lot, which is 10K, and the margin required to take one trade with a mini lot is $280. And if you have a $1,000 account, you can easily do that. Now you would ask, okay, well, I understand the fact that I need to have a certain amount of money to be able to trade certain volume. Okay. What about, how does that equate to how much money am I risking per trade? Now that is all right here. Since you know your volume is 10K, which is a mini lot, you need to have a minimum of $280 in your account to be able to trade that trade or take that trade with a mini lot volume. And what that equates to is this: per pip. That means you will either be making $1 per pip or you will be losing $1 per pip. Let me show you what I mean by that real quick. And this is a example that I have created. So we already know we have a $1,000 account, okay? We can trade only mini lots. Now let's just say we are looking at a Euro USD chart, and we want to buy the Euro USD at 1.2530. So here's a actual chart of a Euro USD, and it's actually dropping, interestingly enough. So let's just say you look at this and you're like, okay, awesome, I've got $1,000 and I want to trade the Euro USD. I can take a mini lot and my margin would be $280, and I would either be risking, I will be making either $1 a pip or losing $1 a pip. And you want to put in the rate. So you want to buy it at 1.2500, right? Is that what we had? Yeah. Okay, buy Euro, okay. Sorry. You want to buy it at 1.2530. And usually I send trade alerts like that, where I break down the information for them. So you're buying it at 1.2530, and you are expecting that this price is going to go up, that the euro dollar is going to keep on going up. That's why you're buying it, right? Because you want the euro to keep on going up. You buy something if you expect its price to go up initially or eventually. And you're like, here is the stop. What does the stop mean? The stop is telling you hey, even though you are anticipating the price to move up to from 530 and go to like 550, 560, 570, what if it goes against you? What do you do then? So you don't want it to go all the way against you and you end up losing all your money. Nobody wants that. So what you do is, this is the key to success in Forex or trading in general, is you put a stop. A stop is what measures your risk. This is the worst thing that can happen to you in that trade. So for instance, if you're going to be buying euro dollar at 1.2530 or 530 here, you put your stop. Since you're buying it, you want the price to go up. So you're expecting it to go up. But if it goes down, you're going to be losing money. So you put a stop at 500, 1.2500. That means if it goes down all the way to 1.2500, you only lose that much money and you're out. So from 530 to 500, that's your stop. So your risk is what's in between. And that is approximately, what's 530 minus 500? 30 pips. And as you can see, if you click here on in pips button, it shows you that even though your rate is 530 to buy it at, you're risking 30 pips, which is your stop. That means that's the worst scenario that will happen. Okay? Now the second thing, how does that equate to how much money you'll be risking in this case? And the question is here is again going to how much do we have on our hands that we are making, or how much are we playing the account with? So since we have a $1,000 account, we decided we were going to take a mini lot of Euro USD. We're going to buy it at 1.2530. We were going to put a stop at 500. That means we're risking 30 pips, which you can see here in shadow. And how much are we risking? Since we are taking one mini lot costs us $1 per pip. And we are risking 30 pips right now. So that means we are risking $30. On the $1,000 account, you're taking one mini lot. Once again, you're buying at 530, but the worst scenario is that you're going to get stopped out at 500 if things go against you, which happens often in trading, and you would only lose 30 pips, or 30 pips times the price per pip, which is $1 in this case. So $30 on a $1,000 account, which equates to 3% risk on that trade. Now, I hope so far you understand how you're calculating your risk and how much money you're putting. Pretty much the money you're putting is based on the volume that you're trading versus how much margin you have to be able to trade that volume, and that the price per pip for that volume. So if it's a mini lot, it's going to cost you $1 per pip. And since you're risking 30 pips, your risk is going to be your stop, which is 30 pips times the price of your per pip. Now, if you were perhaps taking two mini lots, you would need a margin of $560 in your account. And since you have a $1,000 account, that should not be a problem. And the price would be any movement in the trade, you will either gain or lose $2. So since your risk is 30 pips, again, in this case, you're risking $60 on this one trade, which is on the $1,000 account, 6%. I hope you get this part, because this is the important aspect of it. Now comes the money-making side, which everyone's interested. Limit. Limit is also taking profit. What are going to be my profits? So since we are buying this currency pair, we are expecting it to go up. Okay, so let's just say our first target is, I expect it to go up to 545. So from 530 to 545, that's a gain of 15 pips. Okay, 15 pips. What is your initial risk on this trade? We buy the Euro USD at 1.2530. We are putting a stop at 1.2500. So that means our risk is 30 pips. Excuse me. And our first target is, if it goes up, it's 545. So we are going to be making a profit of 15 pips. Since we are risking 30 pips, and our first target is making a profit of 15 pips, that means we have a potential of making 50% gains. That's where my pictures come from in Instagram, where I say I made a 50% gains, because in a lot of those trades I am risking 30 pips, but I make a 15 pip profit. That's a 50% return on investment if you think about it. And here, let me show you in numbers sense to make better judgment out of this. So we already know we have one mini lot, we have the margin here, and the price per pip is $2, whether it moves up or down. So our risk is 30 pips, so that means 30 pips times price per pip of $2, $60 is what we are risking. Since my first target is 545, which is only 15 pips, my profit at this point will be, if it got to this point of 545, I would have made 15 pips times the price per pip, which is $2. So I would have made $30 in profit. And how much was I risking initially on this trade? $60. So when you're risking $60 and you make $30, that's a 50% gain. I know that was into, just, yeah. So we move on to the second target that I would provide, which is I'm expecting the price to keep going up to 560. When it goes to 560, we make a profit of 30 pips. Now, what we know is that when we're making a profit of 30 pips, what was our risk in this case? Our risk was 30 pips too. So whatever you risked, you made that money back. Hence, you were risking $60 and you made $60. That's how you get a 100% gain. That's how you made a 6% return on that $1,000 investment that you had. And so on and so forth. The next could be 590, where I'm making 60 pips in profit. I was initially risking 30 pips and I made 60 pips. So that is twice what I was willing to lose. I was willing to lose $60, but I made $120. That's how you get a 200% return on investment. And that's how I've had plenty of trades where I've made 500, 800% returns on investment, because whatever I am risking, I make literally 8 times to 10 times that money on a trade. And that's the potential of making money in Forex, is that you have to look at the big picture and understand, I'm going to risk small. I'm going to risk maybe 20 bucks per trade, 30 bucks per trade if I have a $1,000 account, but I'm expecting to make $100 on that trade. So I'm expecting to make 3 times that amount, or 100 times, 100% gains on each trade. So you can always consistently make money. Now, when you're selling, it's the same concept. Let's just say I expect to sell it at 1.25. So when you're selling, you're expecting the price to go down. So your stop is going to be above that price. 530, same thing. We have, the mini lot. We are risking, again, $60. And our limit would be, hey, we're expecting this trade to make us a lot of money. So 470 is the first target that we have, which is 30 pips. And if the trade you're selling is at 1.25, the worst thing that can happen is you will get stopped out at 530 and lose 30 pips or $60. But the best thing that can happen or your first target could be 470. That means you gain 30 pips here, or $60, which is 100% return on investment, because you were risking $60 and you just made that money back. So I hope that this video makes sense to you. as to how things are calculated in this business. If you have a bigger account, obviously there's more potential to make money. Then again, there's potential to lose money. But this is the basics of how you manage your gains. And here's an example, hopefully, of a trade I took where I said over 50% return on investment, meaning if you invested $100 on this trade, you should have made $50 profit. So if I made 20 pips in profit, which is only 50% gains, what was my stop in that case? It would be 40 pips. 40 pips was my risk, and I was probably risking, let's just say, $3 a pip, which is $120. So I made $60 already in profits. That's how you build your account, is you're taking small profits all the time. And that's all I have to say. I think a good site that you can use to look at profit loss calculators is this one, which is, again, oanda.com. They're a platform broker. And here we have 10,000, which is a mini lot, and the closing price is 2530, and our profit would be $30. Now if you had a standard lot, which is 100,000, doing it the same way, buying $300. So this is a good calculator. They provide this tool, and if you can just Google Forex calculators, they tell you, hey, one lot, in Forex currency, which is 100,000 units of something, on a leverage of 1 to 50, means that you need to have $6,000 in your account to be able to trade. And here they just show you the value per pip of that. And just looking at this, I guess, yeah, just examples of how the gains are calculated and whatnot. It's really a simple system. It's just getting comfortable with the terminology. And as I recommend, always start off with a demo account. You don't want to be blowing up your money like that. You don't want to be losing your money just when you're figuring out things. Forex, as I said, is really simple. It's not easy, because no matter how good you are, you will have losses. You see me posting about my losses all the time, that, hey, I lost money on this trade, I lost money on that trade. And I'm not the only one who's losing money on those trades. It's also my subscribers, my clients, my friends are losing money too. So it's part of the game, but you're looking at the big picture. If you're risking 30 pips, your goal is to make at least 30 pips, that you're getting back what you were putting into it. And that's pretty much it. That's all I can say at this point, is that Forex has a lot of opportunities for anyone to get started. And if you're disciplined enough in it, you can be very, very successful down the road. That's all I have for you guys right now. Yeah, pretty much. If you have any questions, feel free to comment on this. Send me a message at fxchronicles.com, at gmail.com, or Instagram, private message me, whatever you guys have. Feel free to contact me. I would love to help you guys out. Hope this video makes sense to you once you're getting started. And that's it, guys. Once again, this is Azam. Thank you, and have a great day.